Okay, commercial loans with David Weissel.
Okay. So, start out with the type of property that someone's wishing to refinance or purchase.
Yeah.
So if it's going to be something like a land development, whatever it's going to be, what does someone have to begin with?
Yeah.
Right? So construction is a different animal, and if it's construction, do they own the land? Or is the land being financed? So many people have lots of things they want to acquire and buy, and they don't have any skin in the game. That doesn't work.
Mm-hmm.
It doesn't work. You can't do that. You can't get anything done. So it's got to be somebody that has some money for down payment, or they own the land, and what's the value of the land, right?
Right.
So you want to talk about something that is an existing property,
Yeah.
then what is it? Obviously, if it's an income-producing property, basically, by and large, it's simply a matter of numbers. What's the income? And if on appraisal, we're going to have the estimated rents.
Yeah.
What it's going to rent for.
Mm-hmm.
And I'm, bear with me while I kind of formulate my thoughts. So the easiest things to finance, of course, are apartment units. It's just numbers.
Yeah.
You got an income-producing property, and you need to service the debt, and basically it's 5% for management, 5% for vacancy, and 5% for the reserves, right? Because things need to be replaced from time to time.
Right.
So it's generally, on an income-producing property, 5, 5, and 5. 15% is deducted from all of the gross revenue on an annual basis.
Yeah.
And then you take the debt service, the mortgage payments, and everything's done on an annual basis.
Mm-hmm.
So, like in the case of somebody that's got a residential property and they got a triplex, and we're having an appraisal done, and the appraiser's doing a rent survey, and that's a different animal, because if I already own the property, we can use the income and the rental agreements. All you have to do is show that that money is being received every month. So, going back to commercial, for example, your colleague is thinking about, has got someone wants to buy a retail center.
Yeah.
So and you saw that email.
Yeah.
And so I gave her a list of things we needed. Personal financial statement. Credit is some concern, because if someone's got horrible credit, it's not easy for them. It's almost impossible for them to get the prime financing. So credit is of concern, and someone's personal income is of concern, but it doesn't carry much weight when it's an income producing property.
Yeah.
So a personal financial statement, a credit report, funds to close. And if it's units, you need the rent rolls. Need pretty much 3 years of financial statements. This is for the best financing.
Okay.
And then if it's eligible, SBA financing is the way to go.
Okay.
So, a list of real estate owned.
Yeah.
A resume on the borrower.
Mm-hmm.
If I want to acquire a retail center, shopping center, have I ever managed one? Or, you have people, if there's a management company that's going to manage it, and, that's usually what we do.
Yeah.
So if I wanted to say, I'm going to manage this thing myself, well, do you have any experience? Have you ever done this before? Like your client that wants to buy that mart, and it has several, products and several, a variety of things. Yeah. So each property is unique in its own way.
Okay.
So like when we were talking about I think your uncle, and he was looking at that property, and it was going to be there in the IE, and it was, what was that? That was, trying to think of the city.
Compton.
No, that's another one. But
Okay.
It was the one he was looking at that was in
Paris.
Paris, Lake Paris.
Yeah, Paris. Yeah.
Right. So when I was going to an investor on that, he wanted to know, well, is the building, the structure it's on there, is it vacant? Is it, what's in the structure? So, when we're talking about I'm kind of bouncing around. If we're talking about, private financing, then we need to see the picture. Oh, we want to see pictures of the exterior and the interior of.
So what's the difference between private financing and the more commercial financing?
Well, the private financing, first and foremost, is the interest rate that's going to be charged.
Okay.
And obviously the value of the property, as you know and I know, it's always value of property.
Yeah.
So it isn't doable where someone can say, I'm going to buy this property for $5 million, it's worth $8 million, and I want a loan based upon the $8 million. The loan is always based upon the appraised value or the purchase price, the lesser of the two, always.
So let's say if he was to buy a property which was like, let's say 10 million.
Okay.
And it's appraised at 10 million, but he's buying it, let's say he's buying it at 6 million. Like
He's buying it at a discount.
He's buying it at a discount. Does he still need to put money in if it's appraising for 10 million?
Yes.
Okay.
Because basically, if you think about it, pretend you're the lender.
Yeah.
You're going to lend the money. So I have no skin in the game. I want to finance the whole 6 million because it's worth 10 million.
Mm-hmm.
What prevents me from walking away? You might say, well, wait a minute, there's 4 million in equity in that property.
Yeah.
But from a lending point of view, it's always based upon the purchase price or the appraisal, the lesser of the two, always.
Always the lesser of the two.
Always the lesser of the two. They used to do these kinds of things where you'd get an appraiser and you pay him some money and he'd puff up the value of the appraisal so that you could get basically 100% financing.
For free, yeah.
For free.
Yeah.
For free. So when we can, we're going to go SBA. We're going to go and get bank financing. And sometimes you got some big deals. You got 100 units, you got 80 units.
Yeah.
You got a mobile home park. Same kind of thing. This guy had a $5 million mobile home park, and it's paid for.
Mm-hmm.
And he wanted to, get a loan. So we're going to look at the numbers. What are the incomes from those homes? What are they paying space rent?
So now another scenario. Let's say there's a gas station, and it's rented out to ARCA for 10 years. Now, you're going to buy that property. You're not going to buy it for your business because it's already leased out.
Okay.
Now, what kind of loan would that be used in that situation?
What kind of loan?
What kind of loan? Would that be an SBA or would that be a different kind of loan? Because it's already leased out for 10 years to someone else.
Yeah, SBA doesn't do gas stations.
So what would be in that situation?
So that's going to be, there's just a smaller group of lenders that lend on gas stations.
Okay.
Because of the hazard, you got to have the environmental, you got to have all this stuff to make sure the tanks are secure. I haven't done a gas station. I've looked into one. I've got lenders that do nothing but gas stations. Like I got some lenders that do nothing but churches.
Okay.
So if you got a church, and you ask the questions, please. You got a church, it's about the plate income.
Oh, wow. Okay.
So it's based upon the plate income.
I didn't even know that. Okay.
on a monthly basis times 4.
Okay.
That tells you what the maximum loan's going to be.
Monthly basis times 4.
Monthly plate income. Monthly
Monthly
income
plate, yeah.
from all donations times 4
Okay.
is the loan amount.
Okay.
So it's every, you tell me this is what the kind of property I've got, and then I'm going to tell you, okay, this is how the loan is based. So if it's units, we can get FHA financing. It takes a while to get that done, so it's 90 days or 120 days, and you're going to get 10% down is all you need, as long as it debt services.
Okay.
So when you're buying a smaller property and it's 7 units, most of the time that doesn't debt service. The income, if it's prime real estate, then maybe those 7 units will service the debt, and you can get away with 15 or 20% down. But usually on smaller properties under 8 units, it's going to be 25 or 30% down, or 35, in order to service those 7 units to support the loan payments and taxes and insurance and maintenance and reserves.
Yeah. So out of all the years you've been doing this work, with the current new guidelines, what's the lowest down payments you've seen in commercial? And what kind of loan and what's the lowest you've seen?
Oh, what's the lowest? Well, again, if it's apartment units,
Yeah, that's the lowest.
10% down.
10%, okay.
And that's going FHA. Institutional financing is typically going to be 20% down.
So you can do FHA for 8 units as well?
You can.
Okay.
Yeah, you can do. Obviously, we do FHA on residential all day long.
Uh-huh.
And so, I mean, FHA will finance a hospital. They'll do an assisted living.
Okay, how would that work with an assisted living? I got an assisted living client for $10 million. Now, they want to buy this property in Lake Elsinore.
Okay.
And the property is abandoned. They need to like construct it. Everything needs to be, the building is there, but inside they need to do everything themselves. So and they got a history of doing, assisted living.
So they got a resume
Yeah, definitely a big resume on that.
of running and owning other assisted livings.
Yes. So how would
So
that
we're
work?
going to talk about doing a construction loan, right?
Uh-huh.
To do the build out.
Yes.
So it's going to start with the value as is,
Mhm.
and what are you going to do? Demo that building that's there?
No,
Or
it's really,
the
building is
structure itself is good.
Yes.
Okay, so I have to look into that.
Yeah.
I have not looked into an assisted living. It's the next best type of property
Okay.
because of the demand.
Okay.
As the population grows older and we got the baby boomers and people are living longer, so there's a tremendous demand.
But it can convert into an FHA.
I believe the answer
Yeah.
is yes.
Wow. Okay.
Yeah, I think that can be an FHA loan. You don't, there are types of construction loans that it rolls from the construction loan right into your takeout or your long-term financing,
Yeah.
all one loan.
Yeah.
So that is available.
Okay.
So I have to get back to you on
Yeah.
assisted living
Yeah.
to see how we would do that deal. So that deal's got the building on it. It is vacant
Yes.
and it's not been used. In other
No,
words,
no.
it's vacant.
It's vacant and it's empty.
Oh, empty.
Yeah.
Okay. So with construction loans,
Mhm.
the key is, what is the skin in the game?
Yeah.
So if I own the land and I want to construct something and go ground up construction,
How would that work? Like in a ground up, how would that work as a
Okay.
construction loan?
so you have to have plans.
Yeah.
Got to have the architectural done.
Mm-hmm.
Probably have to have an environmental study done
Yeah.
on the property itself to see its impact, right? And so you have a budget. You have to show a budget and break down everything line by line. And then the lender sets aside an interest reserve in order to pay the interest while it's being constructed.
Okay.
So, and then you've got to have who's going to build it? Is it going to be an owner builder? In other words, who's going to be the guy that's going to be in charge and overseeing the project?
Yeah. Okay.
So owner builders need to have the experience. So somebody I want to build this thing and I've never built a property in my life. Well, I have to see how easy and usually you have to have reserves equal to 6 months times the payments.
Okay.
6 months, and it may I think it's 6 months of payments.
Yeah.
Need to be in your reserves after you acquire the property.
So is the interest rate on construction loans different? Is it higher? And is the time period to be like 2 years, 1 year? How's that normally is?
Okay, typically, depending on the time of year you're borrowing the money, when can you start construction? But the average is 18 to 24 months. And so you need to have that built within that time period. So
Okay.
12 months, sometimes that's the construction loan is 12 months. Depends on what you're building, right?
Yeah.
So that's it, the cost to build, the budget, and then as certain stages have been completed, now the lender, they hold an escrow and they release funds to pay the contractor and subcontractors at various stages throughout the project.
Milestone based, yeah.
Yeah, so then typically it's 5 or 6 draws. So someone I'm trying to think of the term of that person that oversees the entire project. So whoever that person is,
Project manager.
project manager, I believe
Yeah.
is right. So they're going to say, okay, this part has been done. And now inspector's going to come out and inspect it to see that it's built to code, and then they will release a draw as each portion, if you will, or step, a phase has been developed. So sometimes you've got a big, huge project and you're going to build it, you know, this many units, this is phase 1, and this is phase 2, and this is phase 3. So you could get one loan for all of them. And then, you know, if it's going to be something you're going to build out and you're going to sell, you have to have a certain number of units that are pre-sold.
Okay.
So that,
you can sell while it's being built at the same
right.
time.
That's right. Now
Okay.
you can't fund any of them until I think it's fully constructed. I think it's got to all be built
Yeah.
before you can close the first escrow. But you
Okay.
can pre-sell.
Okay.
Pre-sell. That's what they want. That.
Yeah.
Yeah. So I got so many pre-sold, and I'm trying to remember the number. You got to give me a chance because.
Yeah.
Certain depending on what it is, I just make some phone calls and I say, okay, this is what I've got, and I think the pre-sale number is something about 70% have to be pre-sold.
Okay.
I think that's about right. Could be 75.
So what is considered pre-sale? That means that
Means someone's saying, I'm going to buy this property when it's built,
give a deposit.
when it's done. Here's a deposit
Okay.
to buy that property.
But you can't just sell like that entire. You can't collect the entire amount for that pre-sale.
Oh no. Oh.
Even if it's built out. Like let's say you got these multiple condos you're making, and each one is built independently.
Okay. Well, let's think about that. So.
The detached condos.
Detached condos.
Yeah, detached
Oh,
condos.
okay.
Yeah. So you building the detached condos. Can you like sell one and then continue from there, or?
That's the question I need to get
Yeah.
back to you on. I'm not sure of that. I got to think about that. So they're individual condos, they're detached, if
Yeah.
you will. And can I close on this one before the others are built? Have to get back to you.
Okay.
Not sure of that.
Yeah, that's what they completely there.
That's a good question.
Yeah.
That's a good question. Like we say, that's a good question. When I don't have the answer. So, yeah, I mean, I'm not going to.
But is the interest rate on construction loans higher than a typical, 30-year?
It is.
It is.
So it's depending on the strength of the borrower.
Uh-huh.
And but we're looking at not much more, 1% or 1.5%. It's not going to be some 6 or 7% construction loan, unless we're talking about a borrower that's weak and they're not providing any taxes and they're just providing self-prepared financials, which there are lenders that love doing that, and that's what they do.
What is self-prepared financials?
Well, it means it's not audited.
Okay.
They're unaudited.
Oh, wow.
So I make them up, I prepare them, and they're just a piece of paper. Nothing to prove them.
Okay. Do they have to provide anything else with that, or?
No.
And that's for regular. Okay.
Yeah, that's for your less attractive financing.
Uh-huh.
So if somebody like remember the client you have
Yeah,
that pretty much is that trucking industry.
Yeah, about
and
5 million one. Yeah.
doesn't show much income.
Yeah.
So his taxes aren't going to support anything.
No.
So that lender said we don't need any of that. Just make up some financials, show us the money to close, put the money in the bank before it closes.
Yeah.
That's it.
I remember he really loved the interest rate you were giving him, even on that one.
Well,
yeah.
wait. I've got other lenders, but this one particular investor, we call him investor when we're not wanting to disclose who the lender
Yes.
is, but in essence, they're a lender, right?
Yeah.
So that lender said, no, the range is going to be 7 to 12%.
Mm-hmm.
Don't be quoting the guy 7% because buyers always hear the lowest number. That's all they hear.
Yeah.
So I've made that mistake. I made a lot of mistakes over the years.
Yeah.
So don't say, because when I say it's going to be between 5 and 7, they heard 5.
Yes.
And that's what I want, the 5% you quoted me. No, I didn't say that.
That always happens.
Always happens.
Yeah.
Always happens. So, and my friend Jess, who you know,
Yeah.
he doesn't do that.
No.
He's always quoting the high side. It's much better for us to come in and say, I got you a better deal than I told you.
Absolutely.
That's the way to do business.
90% of lenders, they give you always
The
pre-approval.
They're quoting
is gonna-
aggressively. Yeah.
Yeah, the pre-approval is something else, something, even close to closing, the price is still something else until the closing disclosure arrives. Yeah.
Yeah, until you're locked.
Yeah.
So that's, when you're talking about a commercial deal, like I had worked on a loan and this owner had about 20 or 25 million in real estate, and he had very little debt. I don't know if he had 5 million encumbered, 20 million. So he had, or 25. So he was strong.
Okay.
And the guy had years of experience, and I think I told you the story. He wanted to refinance a $4 million loan. And so here's some of the mistakes that we make. Now we're talking about refinancing. So to switch gears for a minute, the most important thing to do is see that existing note. The most important thing. Why? Because the note is going to spell out if there's a prepayment penalty.
Yeah.
But the point is, this guy was 86 or so, and his wife was about the same age. And we drove out to Big Bear Lake, take this long ride, go up there,
I'd be in there.
look at the mobile home park. He's so proud of my park that's worth $5 million. That's all paid for. He's showing one of his assets, and so I go and take pictures, and I'm looking at the units that were a city close to it, and so it was 104 units, and the value was, I don't know, I'll say about 8 million, 7 million value, plenty of equity, debt serviced all day long. And I found an insurance company, and it was Fireman's Fund or something. So I went to a guy, and he said, we got a great deal here. And I said, he can't go around this? Oh, no. I have an exclusive arrangement. Once I present the deal, we're protected.
Okay.
So we had the letterhead. Here is our letter of intent. Here it is. Here's the terms. Here's the deal. And, well, now, got to have an appraisal done. We actually have to pay a commitment fee of 1%.
Commitment fee?
A commitment fee.
Okay.
Because basically that insurance company is committing at $4 million in funds.
Okay.
So what people do all too often is they change their mind. Okay, I don't want it now.
Yeah.
I found someone else quoted me some other deal.
Yeah.
Happens all the time.
Okay.
So when terms have been issued, here are the terms, here is the deal. It was all spelled out on the insurance company's letterhead. Here you go, signed, wet signature. And then we said, okay, you need to pony up 1%. That's 40 grand.
So
and this man said, I'm not doing that. I'm not paying anything. The deal never got done.
So what's the difference between insurance lending and bank lending? I never heard of that too much.
Well, when you go to an insurance company, they want the bigger deals.
Yeah, I heard about that.
You're talking 10 or 20 or 30 or $50 million deals. So, as an example, I go to Metropolitan Life, and they want those big deals.
Okay.
They love them. So Metropolitan Life was a company that, and I don't know if things have changed. It's been a while. And they said, listen, once we're in contact with the borrower, you're not protected.
Yeah.
That borrower can say, I don't want to deal with this broker now.
Yeah.
Cutting you out. So you always have to have, in those cases, always have to have a fee agreement. You always have to have that in place and executed so you have a chance of getting paid.
Okay.
So it depends on the lender. Some lenders on commercial deals will collect our points for us.
Okay.
And then pay us.
Okay. So you do a lot of residential, like all the time. So are all conventional loans the same, or are they different? Like the terms they look at, the interest, in the FICO score, and the history of work, or is it very rigid, or is there other options when you look at conventional loans?
Well,
what is the QM and non-QM, and what are the difference between these loans?
Okay, so everything is automated now. Back in the days, we had people that actually looked at a file and underwrote that file.
Yeah.
So those days are behind us. So the AUS is called the Automated Underwriting System. That's an AUS. So the most popular ones for Fannie Mae, it's DU.
Yeah.
And with Freddie Mac, it's LP, Loan Prospector. It's just different software. So what happens is, depending on who's processing the loan, and who the lender is, some lenders will run that for you. You submit the file with all the documentation. So I'm answering your question in a roundabout way. And so they run the DU. They run the automated approval. Basically, it's a pre-approval with the conditions to be met Boom, right at the beginning of the loan.
Okay.
So it's based upon loan type.
Yeah.
Is it conventional? Is it FHA? Is it VA?
Uh-huh.
And incidentally, the easiest loan to get done is the VA.
Yeah.
Going to take care of, and the VA will do loans that no one else can do.
Yeah.
So with a conventional loan, if the loan to value is over 80%,
Uh-huh.
then you have mortgage insurance, or you can get something. Oh, let me go back to the question. So your question is that does it vary much from one lender to the next?
Because sometimes I have a client who doesn't have the full 2 years of work history. They have 1.5 years.
Okay.
So then they're like, okay, they can't buy a house now. So is it different products, or are they just one product for everything?
Okay.
That you have to have 2 years, or you have to have more than 620 credit score, FICO score. Is there something for people who don't have that?
Okay. So, I mean, if you ask me for lenders' names, I'll give them to you because you're my friend. So,
yeah.
For now,
Yeah.
I'll just say I have a lender that is located right here in Anaheim.
Yeah.
We're in Tustin.
Yeah.
FHA loans down to a 500 score.
Down to a 500.
500 score.
Okay.
Obviously, they're not going to get the same rate as the one that has the 680 or the 660.
Uh-huh.
So it's going to be priced higher, about 1% higher.
Yeah.
And when you have those low scores, I'm just talking about low scores for a minute.
Yeah.
So you got sub 620 score.
Yeah.
And pretty much all conventional loans, you've got to have that 620.
Yeah.
Everybody's the same. Why? Because all the loans are being sold to the same.
Yeah, same person.
Not person, but entity.
Yeah.
So they're all being sold to Fannie Mae, so
Uh-huh.
we all have the same guidelines. Doesn't matter who you go to.
So what's it?
So when I got, go ahead.
No, you go ahead.
So when I've got a low score, I got rough scores, I need 10% down.
Mm-hmm.
FHA loan, you got a 550 score, 10% down, 10% down, always.
Okay.
So that's the catch, or that's the caveat. You got low scores,
Higher down payment.
need 10% down.
Yeah.
Can't get away with 3.5% down. And then, as you may or may not know, when we got first-time buyer, a first-time buyer is somebody that has not owned any real estate, all buyers, all borrowers, for the last 3 years. So if you own property over 3 years ago, you qualify as a first-time buyer.
Yeah.
And so with those programs, you've got a Cal HAFA loan, and that's California Housing Finance Agency, and they actually will lend the money. It's a second with no payment, and so in essence, a borrower can come in with 100% financing.
Yeah.
And that's available both conventional and FHA. Both.
Okay. Both.
Both.
I thought it was only FHA.
No, conventional too.
Oh, okay.
It's called the Home something. I got to remember the name.
Yeah.
It's been a little while.
So what's a non-QM role?
So non-QM falls outside the guidelines. A qualified mortgage
Mhm.
is a loan that is sellable
Yeah.
to Fannie Mae, Freddie Mac, Ginnie Mae. They actually don't buy loans; they guarantee loans.
Yeah.
So, but FHA, VA, and conventional, excluding jumbo.
Yeah.
Jumbo's a different animal. And whether it's the conforming conventional or high balance conforming, you heard that term?
Yeah.
So when it's over, what did it go up to? 584 or something, 582. I'm trying to remember what the number is now for next year, because lenders are already making loans based upon next year. Every year, that number changes, every year in January. So going back to what's a non-qualified mortgage, well, we're going to use bank statements.
Oh, bank statements. Okay.
Bank statement loan. And there's even a loan available where you don't even need bank statements. Obviously, those loans are going to be in the 5s and the high 5s and the low 6s, and they're, in essence, a no-doc loan. Just funds to close. Don't have to prove any income. Now, with that loan, what's the trade-off? Well, you need 30% down. I need a big down payment to get that type of loan. So a non-QM loan, you may use personal bank statements. You can use business bank statements. And we take a percentage of the you take the bank statements and you total it up, and you need either 24 months or 12 months of bank statements times 75 or 80%, depends on the lender.
Yeah.
And that is their monthly income,
Okay.
bank statements. So, and I think I sent you a flyer, a hot sheet on, one of my investors
Yeah, you
that
did.
does all of this non-QM stuff.
Uh-huh.
Amazing, incredible. So low scores, you're not going to get anything sub 620.
Mm-hmm.
There isn't any conventional financing, not an option.
Yeah.
So you're going non-QM because of credit scores, because you're not showing income. And incidentally, when you talked about the 2 years, it's always 2 years of residence and 2 years of employment or self-employment.
Yeah.
Same line of work. Now the exception is the doctor and the dentist.
Uh-huh.
I completed my schooling, and this is true of an RN. Same thing. I don't have to have a 2-year history as long as I completed my education that prepared me for my vocation,
Okay.
for
That
the
counts.
job. So I could be a dentist, and I've only been in practice 6 months, and I completed my schooling prior to that.
Oh, wow. Okay.
So that is doable with doctors and dentists.
Okay, another question I have. I had this one lender which approved my client for 3.1%. This client, he had like almost an 800 credit score. He had like almost 200,000 in his bank account.
Okay.
So he was very qualified. But he moved from New York to California
Okay.
about a year ago, and then he picked up the same line of work. So what happened was we made an offer. Now it comes time for the DU and the statement, like how much money he's going to be paying each month. What was that
Okay.
statement? Was like
His pay
yeah,
paycheck or the contract for
Yeah.
his new employment.
yeah,
Is that what you mean?
no,
or-
no, just the statements of his mortgage payments.
Oh, his current mortgage payments that he already has.
No, this is first time he's buying a house.
Okay.
Okay.
Okay. So he's buying a house.
Yeah.
So we're talking about the
So
P&I on the new loan,
yes,
principal
yes,
and
yes,
interest,
yeah. So
and then taxes.
So now he's got 3.5% as a pre-approval. He just moved from a different state.
Okay.
He's got amazing credit. Got 200,000.
And the
bank
same
account.
line of work.
Yeah, same line of work.
Okay.
Now it's coming time to
Run the AUS, the automated approval.
The whole thing is done. Now the lender changed the quote from 3.1 to 5.5. Now, are you allowed to jump like that, or is that like a D from the pre-approval to the actual loan? Can you jump like that, or is that odd, or is
Well,
that
something's missing there because 5.5 is a non-QM loan.
Yeah.
That's no conventional interest rate.
Yeah.
Are you allowed to do that? Well, what changed? See, it's always a matter of what changed. How many months off did the person have?
About like 6-7 months off of work history
Okay, from the job in New York
to
the new job in California. Had he been on that job or hadn't started yet?
he's been on the job for a year,
Okay.
and he's in the same line of work,
Uh-huh.
and he's been
So
in the
there
same
was a
line
6 or 7 month gap in employment.
Yeah.
And what's the reason for the gap?
he started some business or something.
Okay.
No, there was no gap actually.
Okay, because
There
there
was
wasn't
no
a gap.
gap. There
I
wasn't
mean,
a
I
gap.
can be in New York
Yeah.
or some other state,
No, there wasn't a gap.
and I can just simply have a contract for
Yeah.
my new employment.
Yeah.
And use that. It's called trailing income.
Yeah, he did. There wasn't a gap.
So
And
he's
he
been
just-
on the job a year, and is he W-2'd?
Yeah,
And he's
a
getting
W-2.
an hourly or a
But
salary?
he's counting this whole new time as the new 2 years. He's not counting the work he was doing before at all.
Who's not? The lender?
The lender.
Well, the lender's only going to see your income is always based upon your current income.
Yeah.
So you can't count what they was making
No,
before.
he was the history. He's saying he only has 1 year history, not 2 years or 6 years or 10 years, because he moved from New York to California. I didn't understand that
That
at
doesn't
all.
I don't follow that at all. So
No.
it's always, when you say, okay, this lender
Yeah.
came up with this and changed the terms substantially.
Yeah.
Why did they? So many times, people in real estate, because most people in real estate don't understand lending too much.
Yeah.
Right. Unless you're unless you're a lender also, or you've been in the loan business, so there's some information that's left out. So what you're telling me is, as far as you know, there wasn't even a gap in employment.
No.
The same line of work.
Yeah, he just got to a new employer and he just moved over here.
Okay.
That was it.
But the jump from low threes to 5 something.
5.5.
Yeah, and weren't you
And it
going
was
through a
20
broker?
Yeah, it was a 20%.
You're going through a broker.
Yeah, to a lender.
Well, a direct lender?
Not a direct lender.
Yeah, you just name who it is, because I know all the direct lenders. So this was a broker, probably a broker,
Yeah,
and that broker took the loan to another lender. That's what
happened. You know?
That's what happened.
And stuff like that's been
And
happening all the time.
And they took him to another lender, and that lender was a non-QM lender.
And then 2 times this happened this last 4 months, where we given someone a loan application, and more than 40 days, they haven't given a response. Yeah, more than 40.
On a purchase?
One was a refinance and one was a purchase.
More than 40 days.
Yeah, so
That's
30.
6 weeks. That's
Yeah.
5. Okay, gave a loan application to whoever it was that you went to to get that loan.
Yeah, and he didn't respond for 40 days. And called him and said, well, I'm processing, and you know that you can't go above 30 days. So that's a California, that's a law, or that you have to give a reply after you submit an application?
Yeah, well, it depends on if it's RESPA, real estate settlement procedure. If it falls under RESPA guidelines,
Yeah.
You've got to issue a decision.
Yeah.
So sometimes files get suspended because there's something that the underwriter can't complete the underwriting of that file. So you're giving me a little bit of information, and I just need to understand. But some people that are in lending, they give horrible service.
They do.
Horrible. And every time I gave poor service, I lost that account. They said, we're never going to be giving you another deal. Every purchase transaction is of so much importance, because why? I got sellers, I got agents. All these people have a vested interest in this transaction. So I consider it a privilege, and a very important privilege, when someone says, here's a purchase, I'm giving this to you.
Yeah.
So most of the time, when you get the BS and you get not hearing anything, that's not a lender, that's a broker. I'm not knocking brokers, I'm a broker.
Yeah.
But 40 days, no
answer. No. Multiple times.
Yeah, and sometimes then the next question is, and this is, now we're talking about another subject, which is who you're working with.
Yeah.
So all the time this happens. People come into the business. How long you been in? I've been in it 10 years. They've been in it 6 months.
Yeah.
All the time.
They're probably doing something else related to it.
And I'm doing something part-time.
Yeah.
And I'm not even there. And this is not what I do. This is something I do on the side.
Yeah.
And so I can't speak for that person. I don't know the person, but I just know, based upon you're telling me what, a loan application submitted, bank statements, everything submitted that they need to submit the file to a lender, and no word for 4.
And the guy had 800 plus, almost like 802 credit score, FICO score,
which is excellent.
Yeah,
which is
excellent.
outstanding credit. And this is somebody, and this was a refi, or this was a purchase?
Refi.
Okay.
Yeah.
So what are we missing? Did they own other real estate? What was wrong with it? I don't understand.
Nothing at all.
So outstanding credit.
Outstanding credit, had good money in the bank.
Got reserves.
Got reserves, yeah. The only reason they were refinancing.
Cash out deal?
No, just,
Rate and term?
Yeah.
Okay. And what was, because when I'm doing a refinance, it's always about this. Why are you refinancing? Always. So the toughest deals are the ones that I don't want any cash. I just want a lower rate.
So also, what is the typical interest rate you see on a FHA? I know each FHA is different, but what are you seeing nowadays with your clients?
High 2s.
High 2s?
Low 3s.
Yeah?
Yes.
Okay.
Yeah. Now, keep in mind, FHA is a different animal.
Yeah.
Oh, and let's go back to mortgage insurance for a minute.
Okay.
So, let's say I'm doing a purchase, and I've got 12% to put down. So what we do, usually this is a better loan. is it's called self-insured mortgage insurance. So instead of having a mortgage insurance company and paying that separate payment to them, which I believe is now tax deductible, it didn't used to be.
Okay.
So I'm pretty sure that's tax deductible. The lender self-insures. So if an interest rate is 3% without any mortgage insurance, it's 3.25
Okay.
or 3.375 and no separate mortgage insurance
Oh,
payments.
got you.
That's called lender paid mortgage insurance, LPMI.
Okay.
Lender paid. It's built into the interest rate. So the way I sell that loan is I say, hey, instead of having to pay a separate payment, you just pay a little higher rate and you got that much more interest to write off.
All right.
So when you got 15% and 12% and 17% down, that's the way to go all day long. You could even do it with 10% down. So obviously, the lower the down payment, the more the rate's got to go up. But it's not going to go up 1%. So we're typically talking 1/4%, between 1/4 and 1/2%, depending on the down payment
Got it.
and the scores, of course.
All right, Dave. I appreciate your time today.
What? I have to go?
So, no, I gotta go. All right. So,
Just to let you know, I would have another hour for this man if he had the time. Hey, thanks, man.
all right. Thank you.